The most explosive and profitable moves in the market are breakout trades. But to capture that kind of momentum, you have to know exactly where to draw the boundary lines. Most beginners fail because they attempt to trade every single line they draw on a chart. This lack of filtering makes them easy victims for market traps and false breakouts. By the end of this video, you will have a specific step-by-step checklist to identify, draw, and validate a highly reliable breakout level so you can trade with absolute confidence. To follow along, you will need your charting software open, a basic understanding of candlestick charts, and a standard volume indicator visible on your screen. Relying on a strict, rule-based setup is the only thing that separates professional trading from blind gambling. Let's look at how to find the right levels. Step 1 is scanning the market for tension. We are looking for a period where the order flow has stalled in a stalemate between buyers and sellers. On your chart, this tension appears as price action compressing into a sideways box or consolidation zone. This tight range is the necessary precursor to an explosive move. Use your charting tools to draw a definitive boundary line capping the very top resistance or the exact bottom support of this tight price action. This chart shows that the containment rule also applies to diagonal boundaries. Whether flat or sloping, the line identifies where the price is currently trapped. Drawing this line doesn't mean it's time to trade. You've simply established the perimeter of the battlefield where the upcoming fight occurs. Next, we apply the multiple touch rule. This is the ultimate filter used to differentiate a random line from a concrete, tradable level. A drawn boundary is only reliable if price has historically hit it and reversed on at least 2 occasions, as shown by these purple arrows. Every time price hits this ceiling and reverses, more traders place stop-loss orders just above that line. When price eventually pierces that line, it triggers all those clustered stop-losses at once. This creates the massive burst of fuel required to drive a successful breakout trade. Without verifying these multiple touches, you cannot confirm that enough fuel exists to sustain the move. This makes any resulting breakout highly likely to fail. Even with a validated level, you must protect yourself against the fakeout, the false breakout that traps aggressive traders. This chart illustrates a typical fakeout. Price pierces the boundary just enough to trigger a trade entry, but immediately reverses course and stops the trader out for a loss. Your defense against this is the volume indicator. You must check the volume at the exact moment the line is crossed. To validate the entry, the volume bars must visibly increase and spike higher at the exact moment the price breaks through your boundary. If price breaks the level while volume remains low or flat, you must abandon the setup. Volume serves as the market's lie detector. It proves whether institutional money is driving the move or if it's a trap for retail traders. To summarize the protocol, locate the consolidation, draw your boundary, validate it with at least 2 touches, and demand volume confirmation. Your next step is to set a digital price alert right at your validated line and wait patiently for the market to come to you. Before you enter, you must wait for a candlestick to officially close past the level, supported by that high volume spike. Right now, open 3 historical charts and practice spotting breakouts that were preceded by multiple touches and volume spikes. Consistent trading success is not about prediction. It is about waiting for your specific, rule-based conditions to align before risking a single dollar.